Hello, good evening. It's Adil Fazal here, market analyst at CFDs.com, bringing you a review of the US markets post NFP. Okay, let's try and decipher exactly what's happening here and how the markets have reacted thus far. Be sure to visit CFDs.com, the leading spread betting and CFD brokerage. The website is www.cfds.com. Alternatively, the educational site is www.cfds.education. Okay, so how do we decipher, how do we react, and basically where do we stand in post NFP? Now, in terms of NFP, let's have a look at the actual highlights. Okay, in terms of chronological order, overnight we had the Shanghai. If I can just bring up my global indices, we had the Shanghai and Nikkei higher overnight, although the Hang Seng was certainly negative. We've had European indices. Obviously, you can see here the DAX finishing up almost 1% higher. You've got the Euro Stocks higher. You've got the CAC higher. You've got the FTSE itself as well. Even though it did actually rally towards intraday at high of 6390, it certainly gave back its gains. So you can certainly see here that we started to move lower. So certainly a risk-off scenario thus far. Okay, so in terms of the European, or should we say the FTSE 100, but the European indices rallied based on the fact that the dollar obviously spiked and the euro fell, and therefore created a risk-off tone for the rest of the markets, but a risk-on tone for European markets due to the lower euro. Now the question is, initially we did have this euphoria, and the question really is this: is given the fact that the Fed obviously has no other choice now, given the economic data that's come out today in terms of hiking rates, it basically means or indicates that the Draghi and Mr. Kuroda basically do not need to do QE. Now that could be the potential obviously top in the market. Okay, given especially with regards to European markets, yes, we have moved higher on euphoria, etc. And you can see here the German DAX slamming into its 200 MA on the daily chart. You can see here we had a topping tail at the 200 MA. We reversed ever since. And the weekly chart obviously hits its diagonal trend line. So therefore you are looking at a risk-off scenario in terms of European indices, and that only obviously indicate that you're potential low as well. So these are two factors that we certainly have to consider in order to ascertain the next move in the actual markets themselves. Okay, so certainly the DAX is signaling to you or indicating to you that you do have a potential pivot top in place. Okay, now let's try and decipher this market in terms of economic data. Then the additional economic data that we had this morning was industrial production out of Germany, certainly weaker than expected. We had French data more or less in line. Exports slightly lower. The imports slightly higher. Trade balance itself was more negative, worse than expected. Out of France, the manufacturing data out of the UK actually slightly better than expected, given the fact that the forecast was or previous was minus 0.8. Slightly better, but the industrial production data certainly came out worse than expected. So that was overall a negative from my perspective, certainly from that understanding. Now, in terms of the US data, we had average weekly hours 34.5, average hourly earnings certainly better than expected. Non-farm payrolls higher than expected, obviously 270,000, given the fact that last month or last figure was certainly a blip. Unemployment rate actually dropped from 5.1 to 5%, and thus far the markets have interpreted that as a risk-on scenario. Average hourly earnings certainly twice the number that was expected. So these are all factors that would obviously indicate a potential inflation hike down the road, and that would obviously indicate that the Fed has no other choice but to remain hawkish. Now the question is this: do markets go into a risk-off mode based on the rate hike expectations coming in December, or do markets go into a risk-on mode, given the fact that the stock market can weather the storm and can actually obviously weather the rate hike and can actually discount in and factor in a rate hike, and it is self-sustainable? That's the question. Okay. Now the other question you need to ask yourself, if you are a trader of the S&P 500, the rally on the S&P 500 that we witnessed from here to here was all based on the fact that the Fed would obviously delay rate hikes. Now all of a sudden the rate hikes are no longer being delayed. What does that mean? What does that indicate? Okay, so again, certainly creates a lot of doubt. That's basically what it does. Okay, now it makes you question whether or not this whole rally that was based on rate hikes being obviously pushed back and pared back can sustain itself. And the question is really no. But given the fact that the price action thus far, if I bring up the chart of the S&P 500, and you will be able to see that we have put in a double top at 2102. Okay, and this was on the 5th of November, which was yesterday. Ever since then, we've been putting in lower highs, and we have held double bottom. Double bottom has been 220.86 on the S&P 500. So certainly negative from that perspective. Okay, certainly negative from that perspective. Now, if I just go to the daily chart, you can see that we've certainly broken out the wedge, and therefore one would presume that we are certainly moving our way lower. Now, the S&P 500 is consolidating below this neckline on the H&S formation, and therefore one would presume that we are certainly moving lower based on the S&P 500. Looking at the 10-minute chart, you can see that we have put in a double bottom at 2086, and the question now is whether we can actually sustain that and actually hold it. That's the question, okay, from my trading perspective. And that really is the question that everybody is currently contemplating. Now, given the fact that the euro is slipping now, I think we have a dip on the euro now to almost 1.0720. That's certainly helping European equities to a large extent. And will that be sufficient enough to obviously help the actual US markets remain afloat as well? That's the question we ask ourselves, okay? So the S&P 500 certainly is consolidating on the 60-minute chart below its neckline. And given the fact that I put in a bottoming tail, which again, that's one of the reasons why I got out. And I have actually subsequently shorted the FTSE now in anticipation of this H&S neckline playing out, okay? Now, if I cross-verify this movement or price action, really that's what counts. Because price action will tell you whether or not investors are interpreting the stronger jobs data as being bullish, based on the fact that the stock market is finally anyway, post QE world, the stock markets are finally bullish again and can sustain themselves. So fundamentals are strong. That's basically what it all comes down to. Are the fundamentals strong enough to sustain and keep or maintain the actual markets to maintain a move higher on the markets? Okay. And that's the question we need to ask ourselves. But given the fact that the market has rallied already quite substantially, one would presume that that is not sufficient enough. Okay, one would presume. But given the fact that the way price action is trading, you just have to respect it. I mean, that was a hell of a pivot low. We pushed higher, and we haven't failed so far. So my expectations now would be on a potential sell-off going into the close. This is going to be very interesting in terms of observing the price action going into the close today. Again, you got consolidation here, bear flag, and looking for a potential move lower. I did expect the markets to continue higher, but that has not been the case. And the main variable that I'm looking at is a Nasdaq. The Nasdaq must close above 2095 or 46.95 in order to maintain the bullish bias, because it must close above the previous high, and that's not been the case. We've dipped intraday, and from a 60-minute chart, you're still within that consolidation period. You're creating this right shoulder. You've broken below this trend line, and you are looking at potentially closing that gap below. 10-minute chart itself, yes, we have closed that pivot low at the bottom here, or held that pivot low at 46.65. We're currently at the 46.95 level, and we are making horizontal resistance, or holding this key horizontal resistance at 47.07. So again, another reason to be bearish on the US markets. Okay, these are all factors that we have to certainly consider when trading. Now, previous resistance or equal support has held, more or less held here at 46.80, and that needs to be observed as well. But so far, the way in which price action is accumulating, one would have to start to err on the bearish side. Okay, given the fact that we've not really had a bounce thus far, and I did expect a sustainable bounce, but that has not occurred. Okay, so my bias is slightly onto the weak side, especially given the fact that the Aussie and Kiwi have failed to bounce thus far as well, and that's not a good sign in terms of assessing market risk. Okay, that's just my interpretation or my insight into the actual market price action thus far. Okay, so the Nasdaq itself is certainly languishing and failing to break above the key 47.10 resistance. Okay, so therefore we are interpreting that as risk off. Okay, that's what we are looking at present. Okay, now if I just cross verify the Nasdaq itself onto the biotechs, and you can see the biotechs certainly have sold off. They have put in a bottoming tail though, mind you, so bear that in mind. Okay, 10-minute chart, you can see here we flushed. Now it's one of the reasons why I closed the Nasdaq very early, because the biotechs was flushing lower and actually hit that horizontal support zone. So again, this is very, very interesting. So we are making lower lows and lower highs, and that certainly remains the dominant theme at present. Okay, in terms of the actual market itself. Okay, now the daily chart certainly is weak. We are putting in a bottoming tail, so that's something that we certainly need to take into consideration. And also the semiconductors today certainly are strong. the daily chart, you can see a bullish candle there. 60-minute chart, obviously you've come off the lows, and we certainly have been trading higher ever since. The 10-minute chart, you are looking at potentially closing this gap level up here, and again you are into horizontal resistance, so whether or not this can sustain itself is under question. So again, this is something that we're observing and watching, given the fact that the actual Asian markets higher has not failed to propel the Nasdaq higher. Again, this is a risk-off scenario. Okay, again, this is how I'm interpreting it thus far, especially given the fact that 4710 has been rejected in the Nasdaq. Now, if I cross-verify that with the Dow Jones still consolidating within that bearish candle on the 60 minutes. The daily chart broken out the rising contracting wedge pattern, no sustainable move higher, so therefore one has to go or start to go into the bearish camp. Now 10-minute chart on the Dow Transports is again coming into resistance. Now I've cross-verified almost every sector except every chart so far. The Russell, you can see, is still obviously holding resistance here. The 10-minute chart on the Russell again is horizontal resistance and looking to potentially move lower. So again, these are all factors that I'm looking at, and I am convinced that we are starting to move on the downside. Okay. Right, okay, so I'm just taking a short on the Nasdaq as well. So certainly indicating weakness, and this is a short that I've taken on this market now, 46.97 short Nasdaq, and sent out to subscribers. Okay, so certainly a risk-off scenario from at present. I did expect initially, like I said, the actual interpretation that the markets were bullish based on the fact that stronger economic data would weather the rate hike concerns, and that certainly has been factored into a large extent, given the fact that we have rallied, and the Russell obviously is coming into resistance. If you look at the chart of the Wiltshire as well, which is really the good bellwether in terms of understanding, you can see daily chart is broken down, 60-minute chart certainly broken down, and the 10-minute chart you can certainly see we are breaking down as well, still maintaining lower lows and lower highs. So again, argument for a potential thrust and a move lower. Okay, that's my interpretation thus far. In terms of the actual dollar itself, that certainly is an important aspect to observe. As you can see here, Greenhaven commodities absolutely smashed so far. Breakdown, so certainly weak. Next level of support potentially, given the fact that we've got a strong dollar, is going to be 19, and that's obviously going to send US markets lower as well. If we bring up the chart of copper, certainly again weak. You can bring up the chart of gold, you can see it's weak. Bring a chart of oil, certainly weak. No real thrust or movement there off the lows. So that's not exactly a good sign. Okay, that's not something that you want to be observing if you are a bull in this market at present. So these are all factors that I'm looking at in terms of the weakness or the bearish argument. And again, all eyes will be on the S&P 500. I did expect initially, like I said to you, it's all about observing price action and seeing what price action wants to do. Is price action observing that the strong jobs data is now bullish for markets and the markets can sustain themselves, given the fact that we've had a stellar rally already, and will they be able to weather the storm in terms of a rate hike? And that isn't the case. You can see I've allowed this market to rally and move higher, and we've still failed to recapture and trade above the neckline on the S&P 500. So therefore, one would presume that you have an unfilled gap at 2050 region that certainly needs to close, and the dollar itself will remain king. The concerns of rate hike still has won the day, from my understanding. Okay, even though I've given this market now almost 2 or 3 hours now in terms of digesting the economic data and allowing it to show its hand, and the hand it's showing at present is bearish. Okay, and that's my summation post NFP. Once we close that gap at 2050, then we'll see exactly whether or not we can sustain this rally higher, and whether or not stock markets can weather the storm in terms of rate hikes. The only indices that will actually be bullish is going to be European indices, given the fact that obviously a stronger dollar favors a weaker euro, well, equals a weaker euro. But the counter argument to that now, which I've already discussed, is that if the Fed is going to raise rates, that means that Mr. Kuroda, Mr. Draghi do not need to do QE. So no more additional QE basically is negative for European markets as well. Okay, so the QE tap is about to close, and we shall soon find out how these markets react, and it's going to be very, very interesting. Okay, I think that's a summation of my analysis. Be sure to visit cfds.com, and obviously happy Friday, and let's look forward to another trading week next Monday. Goodbye now.